Marcus bought his home in 2015. $380,000 purchase price, $76,000 down payment, $304,000 mortgage at 6.5% on a 30-year term. Standard American homeowner story. His monthly mortgage payment was $1,922. Over 30 years, he was scheduled to pay $692,000 total, $304,000 in principal plus $388,000 in interest. He was going to pay for his house twice. 9 years later, his mortgage was gone. He paid $148,000 in total interest, a savings of $240,000, and he owned his home outright at 42 years old. This is the exact method he used. Before we get into the strategies, you need to understand how mortgage amortization works, because it explains why these tactics are so powerful. In the early years of a mortgage, almost all of your payment goes to interest. In Marcus's case, in month 1, $1,649 of his $1,922 payment went to interest and only $273 went to principal. He was paying off less than $300 of actual debt per month despite making a nearly $2,000 payment. The amortization schedule is front-loaded with interest by design. This is how lenders make money. And it means that every extra dollar you pay toward principal in the early years of the loan has an outsized impact, because that extra dollar eliminates future interest payments that would have compounded over decades. Think of it this way: $1 of extra principal paid in year 1 of a 30-year mortgage eliminates roughly $4 of future interest. That is a guaranteed, tax-free, risk-free $4 return on a $1 investment. Marcus understood this. He used 3 specific strategies in combination. Strategy 1 is the simplest and requires no extra money at all. Instead of making one monthly mortgage payment, Marcus paid half his mortgage every 2 weeks. Half of $1,922 is $961. Paid every 2 weeks. Here is why this matters: there are 52 weeks in a year. Biweekly payments produce 26 half payments per year, which equals 13 full monthly payments, not 12. You make one extra full payment per year without ever feeling like you are making an extra payment, because the money comes out of biweekly paychecks naturally. That one extra annual payment goes entirely to principal. On a $304,000 loan at 6.5%, switching to biweekly payments alone saves approximately $89,000 in interest and cuts 6 years off the loan term. You end up paying off a 30-year mortgage in 24 years with zero extra cash outlay. Most mortgage servicers allow biweekly payments. If yours does not, you can accomplish the same thing by dividing your monthly payment by 12 and adding that amount to each monthly payment as extra principal. 1/12 of $1,922 is $160. Add $160 to every payment, label it as additional principal, and you achieve the same result. Marcus set up automatic biweekly payments from day 1. This was his foundation. Strategy 2: every month, Marcus paid an additional $500 toward principal on top of his regular biweekly payment structure. Where did the $500 come from? Marcus reviewed his budget in year 1 and found $300 in subscriptions and dining he genuinely did not value. He picked up freelance work that generated an average of $400 per month in year 2 through 4. He directed all of that excess cash at the mortgage. $500 per month in extra principal payments, combined with the biweekly structure, dramatically accelerates paydown. Here is the combined math. Regular payments on schedule, loan paid off in 30 years, $388,000 in interest. Biweekly payments only, 24 years, $299,000 in interest. Biweekly plus $500 per month extra, approximately 12 years, $158,000 in interest. He was already most of the way to his goal with just these 2 strategies. The additional savings compounds on itself because every extra dollar paid early reduces the principal balance, which reduces the next month's interest charge, which means more of the regular payment goes to principal, which accelerates the payoff further. It builds on itself. The key discipline: Marcus paid the extra $500 every single month without exception. When cash was tight, he paid $250. When cash was flush, he paid $750. But he never skipped it entirely. Consistency mattered more than the precise amount. Strategy 3 is what compressed the timeline from 12 years down to 9. Twice during those 9 years, Marcus received large lump sums and applied them directly to mortgage principal. Year 3, tax refund of $4,200, plus a work bonus of $8,000. He put $11,000 straight onto the mortgage. Year 6, sold a vehicle he no longer needed, netted $9,500. Another $3,000 bonus. $12,500 to the mortgage. Those two lump sum attacks totaled $23,500 and eliminated roughly $58,000 in future interest while cutting 3 years off the remaining timeline. The psychology behind lump sum payments matters. Most people receive a tax refund, a bonus, or some windfall and immediately think about what to buy. Marcus had a pre-committed rule: any money above his normal income goes to the mortgage first. He set this rule before the money arrived so he never had to make the decision in the moment. This is a behavioral technique, pre-commitment, and it works because the emotional pull of spending money is strongest when the money is in your hand. If you have already decided in advance what to do with it, the decision is already made. Combined result: 9 years. $148,000 in total interest paid instead of $388,000. A savings of $240,000. Mortgage-free at 42. The most common objection to aggressive mortgage payoff is, would you not be better off investing that money instead of paying down debt? It is a legitimate question and the answer depends heavily on the mortgage rate. At 6.5%, your guaranteed, risk-free, after-tax return from paying down the mortgage is 6.5%. This is because every dollar of debt eliminated saves you the interest you would have otherwise paid. That is a guaranteed return with zero volatility. The S&P 500 averages approximately 10% annually, but with enormous volatility. The standard deviation of annual S&P returns is roughly 17%, meaning in any given year, you might earn 27% or lose 7%. The 10% is an average across decades, not a guarantee in any given year. For Marcus, the honest math is nuanced. Had he invested the extra $500 per month and the two lump sums into index funds instead of the mortgage, assuming a 10% return, he would have accumulated approximately $110,000 to $130,000 in the investment account over 9 years while still carrying $200,000 in mortgage debt. Net wealth position, roughly the same as being mortgage-free. But here is what changes the calculus. First, mortgage interest deductibility has declined with the standard deduction increase. For most middle-class homeowners, the mortgage interest deduction provides minimal benefit. Second, at 6.5%, the spread between the debt cost and the expected investment return is only 3.5 percentage points, not enough to justify the certainty versus uncertainty trade-off for many people. Third, job security risk. An investor who loses their job still owes a $1,922 monthly payment. An investor who owns their home outright has cut their minimum monthly expenses dramatically. The conventional financial advice of invest instead of paying off low-rate debt works well at 3 and 4% rates. At 6 and 7%, it becomes a much closer call, and the guaranteed return of debt elimination often wins on a risk-adjusted basis. Let us talk about something the spreadsheet does not capture. At 42 years old, Marcus has zero housing debt. His monthly expenses dropped by nearly $2,000. His career risk tolerance changed. He could take a lower-paying job he preferred because he no longer needed the income to cover a mortgage. His relationship with money shifted from defensive to offensive. Studies on financial well-being consistently show that debt elimination, particularly mortgage elimination, produces measurable improvements in psychological well-being, relationship satisfaction, and risk tolerance for career and business decisions. The peace of mind of owning your home outright has a real, quantifiable value that does not appear in a rate of return comparison. This is not an argument for ignoring math. Marcus did the math. The math was close. And in a close situation, the guaranteed outcome that also provides massive psychological benefit won. Here is how to apply this starting today. Step 1. Call your mortgage servicer and confirm they accept extra principal payments and biweekly payment setups. Most do. If not, you can manually add 1/12 of your monthly payment to each payment labeled as extra principal. Step 2. Set up automatic biweekly payments or automatic extra principal transfer, whatever your servicer allows. Step 3. Decide on a fixed extra monthly amount and automate it. Even $100 per month accelerates payoff and saves tens of thousands in interest. Step 4. Pre-commit your next windfall. Tax refund, bonus, inheritance, decide now, before it arrives, that a fixed percentage goes to mortgage principal. Step 5. Track your progress on an amortization calculator. Watching the payoff date move closer every time you make an extra payment is a powerful motivator. You do not need to pay off your mortgage in 9 years. But you can pay it off in 18 instead of 30 with minimal sacrifice and save $150,000 in interest while doing it. The method is not complicated. The math is absolutely on your side. Word count, 1/300 duration, 10-minute end card. Next video, the HSA is the most powerful account in America, nobody uses it right.